At their last meeting, the Federal Reserve raised the overnight rate by 25 basis points, raising concerns about whether this was the last increase of the cycle. Powell did not telegraph another rate increase, but also did not confirm that there would be no more increases. Currently, Wall Street predicts an 80% likelihood that the overnight rate will remain unchanged when the Federal Reserve meets in September. Additionally, they predict a 70% likelihood that rates will remain flat in November and a 61% chance they will remain flat again in the December meeting. Overall, it's likely that the Federal Reserve will keep rates flat for the remainder of this year, which will be a welcome change for commercial real estate investors. According to Chang's estimates, as long as there's no significant unanticipated surge in inflation, the Federal Reserve should hold off on additional rate increases. If the Federal Reserve does indeed hold rates flat through the remainder of the year, the real estate market will benefit in three ways. Firstly, it should help stabilize the lending climate, with borrowing interest rates potentially coming down and lenders possibly loosening their lender criteria. This is in turn may encourage more banks to enter the lending market as well. Secondly, it'll help buyers underwrite assets more accurately as financing and interest rates become less volatile. As a result, this should help reduce the buyer-seller expectation gap. Thirdly, it will reduce uncertainty, which has caused many investors to pause on their activity due to many variables at play. Stable interest rates and reduced uncertainty, should bring more investors back into the market, facilitating the price discovery process and further reducing uncertainty. Chang offered a few reasons why the Federal Reserve probably won't have to raise interest rates again. Firstly, there have been a significant decline in several inflation measurements, such as the Consumer Price Index and the Producer Price Index. Secondly, student loan payments are resuming in October, which is estimated to reroute about $70 billion per year into debt repayment that might otherwise go into consumption. And this should restrain consumption, particularly in conjunction with falling levels of personal savings. Finally, economic momentum is tapering, with job creation slowing down significantly. In the second quarter of this year, an average of about 244,000 jobs were created per month, compared to an average of 330,000 per month in the second quarter of last year. The Federal Reserve is also uncertain if the rate increases are already playing out in the economy or if the true impact is yet to come. As a result, unless they have a specific reason to raise interest rates, they are more likely to take a wait-and-see approach, at least over the short term. Now, if you're in need of an experienced commercial real estate broker, I can be reached at 281-222-0433. Appreciate your time and have a good day.